2, 1. Good afternoon, Quasar Markets Live. Welcome back, and I am so happy to have Dr. Alan Ellman, the president of the Blue Collar Investor Corporation, here to talk more about his covered call strategies, his cash secured put strategies. And this one really interests me because I've never thought about using this with a system like yours. I've played iron condors and collars in the past, but we're going to talk a little bit about using a collar strategy with your BCI trade management calculator. How are you doing today, Dr. Ellman?
Doing great. It's always good to speak with you, Howard.
Glad to have you. So this was interesting to me because I am, even as a beginner option player there, I was familiar with what a collar is in general, but I hadn't thought about it as a tool that you would really use, and it made me again. I don't like to break your, I don't want you to break your arm patting yourself on the back, so I'll help a little bit, but it really shows the difference with what you've put together over the last 30 years. Is this isn't something I've seen any other educator talking about in the use and the way that you are. I've already dived ahead and went through the PowerPoint, so I know what's coming. And it really is an impressive technique. When did you come up with this? Was this an early one or a late one in your sort of portfolio?
Howard, one of the things that I'm truly blessed with is that my members are always sending me questions and making comments and talking about their own personal strategies. So probably it's got to be more than 20 years ago people started asking me about protective puts in conjunction with covered calls. And of course, whenever I get something like that, I start trying it myself. I start looking for ways to calculate these, to figure out the pros and the cons. And so, to answer your question, I started doing these strategies about 30 years ago. I'd say the collar probably came into play maybe 25 years ago. And
Okay.
I've been writing articles, doing videos on these ever since.
Okay, great. Let's get right into it then.
Okay, well, yeah. I mean, the first question is, well, what is a collar? So it is a covered call writing like strategy. It's not traditional covered call writing because we're adding a third element into the equation, and that is the protective put or an insurance policy against catastrophic share price decline.
Okay.
So you do your covered call, you buy the stock, you sell the call option. In the case of a collar, it would be an out of the money strike higher than current market value. And then you purchase an out of the money put option. So you're buying the put option, you long the stock, you long the put, and you short the call. And what the put option does is protect you if the share price declines dramatically, you have the right to sell the shares at that strike price. So yeah, so it's three legs instead of the traditional two legs for a covered call. Now, Howard, you'll notice, can you
Go
go
back.
back to
Yep.
that last slide? You'll notice that in the third bullet point, I put in what is the split strike conversion strategy?
Yeah.
Now, you may have been scratching your head. What the heck did he put that bullet in for? And what is the split strike conversion strategy? Never heard of it. Well, this is just a fun fact when it applies to the collar because this is the strategy that Bernie Madoff pretended to use.
Oh, really?
So he claimed that he developed this split strike conversion strategy, which is really a collar. And he called it this fancy name, and the immediate world bought into it.
Yeah.
So, in essence, and the whole irony of Madoff is that had he actually used this strategy, he actually could have made money for his clients.
Right.
Now, I don't know if he really knew how to use it, but the fact is that what he was telling when he was saying split strike conversion strategy, all it is the collar strategy, period.
That's
That's why I
funny.
put that in there, just as
That
a
is
fun
funny.
fact.
Yeah, that is interesting, especially as it's finally wrapped itself up and everything else. And now it's been surpassed by FTX as the largest scam in the world.
Nobody ever thought that anyone could beat out Madoff. But
And they did it
in
pretty
any
well and pretty
case,
quick.
the collar is an insurance policy,
Yeah.
and I've spoken with you in past discussions regarding free insurance in the form of in the money call strikes, which have an
Right.
intrinsic value component, which in essence is an insurance policy. You have greater downside protection because of that additional intrinsic value component of the premium, but that protects you only so far.
Right.
So if the price of the stock drops below the break-even price point, even when you're using an in-the-money call option, well, then you could start to get hammered. So the collar, having that protective put, protects you against substantial share price decline. And that you could use the collar in various scenarios. And I put 5 bullets here just to
Yeah.
give your viewers an idea. Um, an earnings report. Now, I am 100% from the school that
Right.
you never ever write an option with an upcoming earnings report. But there are some people that want to do that, and they understand that if there's a miss, it can cause a significant amount of share price decline. So having a protective put in place would make sense if you're going to do a covered call around an
Right.
earnings report. I would never do it, but there are some people that do. So at least have that protective put in place. Also, think 2008,
Yeah.
2022, right? Having those protective puts would have helped quite a bit in bear and volatile markets. Also, there are certain events you may want to put a protective put in place, like with Brexit, or maybe a especially important Fed announcement, or
Sure.
like the recent election, if you were unsure as to what was going to go on. That would also be another few situations where you may want to include a protective put. And, what if you have a stock that's gone to the moon, right? And you're writing covered calls, out of the money covered calls, but you also want to protect against egregious share price decline. In that case, also, you may want to have a protective put in place. So,
Right.
although another,
I just want to stop you there because I think that you're hitting on this at a perfect time because a lot of people are in this. I know that the example you're going to use here is a perfect example of that with Nvidia, but for people that have been in micro strategy, some of these other tech names that are just blowing through the roof, we've also seen people like Steve and some other analysts out there predicting a 10, maybe a 5 to 10% pullback here before we see it move back up. So this would be a good way to protect against those, if you're worried that that 5 or 10 could become even bigger. And I'm very interested in this, and maybe this is something to use on Bitcoin. Like I said, I don't like to sell my Bitcoin. So maybe, I'm in this boat because of the volatility where this might be good for those days like the other day where it dropped down from 100 to 92.
there is so much you could do with these strategies to protect yourself if you're expecting a market decline or you're worried about a market decline. I mean, instead of buying a stock, you could sell a deep out of the money cash secured put.
Right.
And
Absolutely.
then if there's a put to you, you can then write an in the money call strike. Maybe one time we could talk about, I
I
call
like
it the
that.
PCP, call put, or the wheel strategy. So that's something that, but there's so much, and this is what I want to get across to your viewers here, is that there is so much you could do to craft your trades based on what's going on today. And it's not one size fits all. And various times you may be more bullish on how you craft your trades, you may be more bearish, or you may do some combination of the two. So if the last bullet, Howard, if you can't be near your computer, maybe you're traveling a little bit, but you still
Absolutely.
want to have your trades in place, well, go ahead, spend the money on a protective put, and you have now insurance. You can go have a good time when you
It's
get on
almost like
that
an
cruise.
added travel insurance.
Exactly. Great way to put it, Howard.
Yeah, and and like you said, I think that it's also very important to bring up that about there's not one size fits all to our new viewers because we've been in a pretty good bull market here. And I can remember in the crypto bull market of 2020, everybody thought they had all the answers. And again, when I got into more into stocks and options during COVID, again, when everything was moving up, everybody thought they were a genius and they could just buy an open call, an open-ended call, and it was going to hit, and then they were in the money. So I do think it's so important that we are constantly educating our viewers that it isn't a one size fits all, and not every market. We play the market in front of us. You'll hear that from out the educators that we talk to on Quasar Markets all day long, playing the hand in front of you, because it does change. So I just want to bring that up also.
Well, a lot of what you bring to the table through Quasar is experience. I mean, a lot of the speakers have gone through bull markets, bear markets,
Absolutely.
and everything in between, and so you know that in a bull market, that if you're trading long enough, you're definitely going to experience bear and volatile markets, and then you have to be prepared. How am I going to
Absolutely.
handle those particular situations?
It's like we said, it's being prepared. The old Boy Scout motto comes into play is, if you're prepared for it, then you have a plan and you're able to execute. That's why your system is so great with all of the exit strategies, all of the management strategies. Not only once that once you get into a trade, it's not over. And that's so important.
So in the slide that you're showing now, Howard, it just talks about the three legs of a collar. So you
Yep.
start just like a covered call. You buy the stock, or perhaps you already own it, and then once you're covered or protected because you know your cost basis, you're then free to then sell the option. Now, in the case of a collar, you're pretty much going to be selling an out of the money call, which creates a ceiling because you're contractually obligated to sell the shares at the strike price by the expiration date. That's why we're getting paid when we sell a covered call.
Yep.
So that's the second leg of the trade. And then, as we said, the protective put, which is out of the money. And for puts, that means lower than current market value. And that will then set the floor, which means that if the price of the stock drops below that out of the money put strike, we don't lose any more money. That would be the worst case scenario
Yeah.
would be that we could sell the shares then at that put strike price.
Absolutely.
So again, buying a protective put, now a married put just means you're buying the put at the same time that you bought the stock. You're purchasing the contractual right, but not the obligation to sell our shares at the put strike by the expiration date. So in that case, we have a measurable maximum loss on the stock side. That's the advantage of the
Right.
protective put.
Absolutely.
Now, I've said this in previous discussions. Now, option buyers and option sellers. Now, in this particular case, we're both, right?
Right.
We're selling the call option and we're buying the put option. So, option buyers, in our case here, the put, we have contractual rights to sell at the strike price. Option sellers, again, that's us with the collar, we have the contractual obligation to sell at the call strike.
Absolutely. And the brokerage makes sure that we have all that set and in place and don't remove one without the other.
Yes. Now, the example that I provided for this particular discussion is NVIDIA. And about 10 days ago, I made this slide, November 27th. And at that time, NVIDIA we were going to was trading at 132.67. So again, an out of the money call strike would be 134 as one example,
Yeah.
and I'll show you the option chain in just a second. And that had a bid price of 530. So that creates the ceiling at 134. In other words, if Nvidia blew past 134, went up to let's say 138, we would only get 134. That's our maximum gain. That's the ceiling in the trade. Now, we buy to open and out of the money cash secured put. In this case, I used the 128 put, which cost, so there was a debit of 345. So we had a credit of 530 on the call side. We had a debit of 345 on the put side, and that is our floor, Howard. In other
Right.
words, if NVIDIA goes below 128, we don't suffer any more damage.
Yep. Almost like a built-in stop loss.
Exactly. So here's the option chain just to show you viewers what I was talking about. And it was 1127 that I created this screenshot, and it's for the December 27th, so about a month out, 31 days for expiration. And
Okay.
the red arrow on the top shows the bid price when we sold the covered call, $5.30 or $530 per contract. That's how much cash is generated into our account when we sell the covered call. Now, on the bottom of the screenshot, we have the put premium, and you'll notice we're not using the bid column now, we're using the
Yes.
ask column. So we always sell at the bid the lower, buy at the ask higher. And you'll notice for NVIDIA, because it's very popular underlying security for options, that the bid-ask spreads on both were very small.
Yeah.
For the put, it's 335 to 345, and on the call side, it was 530 to 535. So we're going to get favorable trade executions because of the tight bid-ask spread. So there
Yep.
are the numbers that I alluded to before, 530 and 345.
Absolutely. Now, did you are you looking at any of the what components are you looking at there, or any of the delta, the gamma, or anything to make the decision on your spread, or are you basing it just on your thesis of what it can move up? Or I don't, do you have anything in particular that makes you choose one strike over the other?
Yes. With covered, let's just focus in on the covered call aspect of it
Okay.
because I look at it that this is a covered call trade with
Okay.
insurance.
Insurance. Yep.
So
Makes sense.
I focus in on the covered call trade, and I have a system that I've been using for 30 years. I mean, it's been improved over the years, obviously. But what I do is the following. First, I decide whether or not I'm going to take a bullish or bearish approach. And a bullish approach would be an out of the money strike, right? An out of the money. And and then I say to myself, what am I trying to achieve here? What is my initial time value return goal range? Because if you don't know that, how the heck are you going to know what strike to choose if you don't know
Right.
how much money you seek to generate? Now, so if these are the initial returns, now the final returns could be higher or it could be lower, but that's your starting point. That's what I use on my bullish or bearish, in the money, out of the money, and what is my initial time value return goal range. Now I'm going to go 2 to 4% per month. I'll go as high as 6% in a bull market like we've had this year,
Okay.
but I'll never go higher because that means that the risk, I'll never go higher. Let me just define that for you for near the money strike, uh, because that means there's a very, very high implied volatility. And then you're taking a low risk strategy like covered call writing and
And
converting it into a much higher risk strategy. And I don't want to do that.
right.
So yeah, that's my starting point. And then the put is simply insurance on that covered call trade.
Right. Okay. That makes sense to me. Absolutely. Perfect.
So I'm going to use the trade management calculator, which we've talked about before, but just to remind your viewers that this is a huge spreadsheet that has over 2,400 different formulas in it. What you're going to
Wow.
see, I believe on the next slide, I can't see what the next slide is, but I believe it is. You're going to see okay, that's what I thought. Let's go back for a
Just
second.
wanted to make sure.
Um, Okay, so you're going to see the trade entry in the blue cells on the left, top left third for the covered call trade. I'm going to piggyback that on the white cell, which gives you your initial trade calculation. So blue
Okay.
cell entry, white cell initial calculations for NVIDIA. Now let's move on.
Okay.
Here we go. So you see here that stock entry price right in the middle was 132.67. We're going to look at the 134 call strike, and you remember that the bid price was
Thirty
$5.30.
cents.
Now we haven't incorporated yet, Howard, the debit for the cash secured put. We have not yet put that into the spreadsheet. I just want to
Okay.
show you the cover call trade with and without the protective put.
Okay.
So now on the bottom row here, the spreadsheet will tell us, okay, if taken through trade expiration, it's a 31-day trade. Now the break-even price point in the yellow cell is 127.37, which is simply the price of NVIDIA 132.67 minus the entire call premium 530. That's the break-even price point. Now, here's the meat and potatoes, Howard. The Based on the 530 31 day, it's a 3.99% 31-day return. Notice how that fits in to my 2 to 4%.
Yeah, right
Okay,
in
and
there.
that's why I would select that strike. Uh, and annualizes to 47% based on that 31-day trade.
Right.
Now, on the bottom right, Howard, is the upside potential, which means that in addition to the 3.99% initial premium time value return, we can also generate an additional 1% if NVIDIA goes from 132.67 up to or beyond that out of the money 134 strike. So there's an opportunity for 31-day return of 5% with
Right.
this particular
Wow.
trade without
The
the
put.
put debit, which we're going to get to in the next slide.
Okay. Without further ado.
So here's what we do. It's pretty easy. Instead of putting in the 530, what we do is deduct the 345 debit from the 530. That
Right.
comes to $1.85, $185 per contract. Now we have purchased an insurance policy, and we know that we're protected underneath that put strike. So once again, looking at the bottom row now, that 31 day hasn't changed at all. You'll notice the break-even price point, yes, is higher now
Yeah.
because of the debit. And the return in the brown cells is definitely much lower, but not insignificant, right? So we
Not at
have a
all. Right.
1.3, not at all. I mean, 1.39%, 16.42% annualized. So the way I would look at it when somebody have seen the first slide and go, whoa, wait a minute now, I'm not going from 4% to 1.4%. I'm not spending the money. But then I might say to you, well, look, it's different for everybody.
Yeah.
Well, let me ask you this. If your local bank put out an ad in the newspaper that they're giving out CDs for 1 year return of 16%, wouldn't that line be around the block six
Yeah, they'd
times?
be He'd be running. They'd be putting down the phone to run. I'm with you.
Exactly. So
Exactly.
60% annualized return is definitely not insignificant. And you also still have that very same 1%. So you can end up with a 2.39% 31-day return
Yeah.
with this particular put trade.
That's almost the
And
year in most money markets outside of in the old world, not the new world is money markets at 4.5, but we lived through years of it at 2. So you would be beating that.
or lower. I mean,
Yeah,
sometimes it'll be like 0.5% or something. You need a
I know.
magnifying glass.
Yeah, I mean that. Yeah, and that is a great way to explain it because it is so hard. Like we said, people get eyes in the sky, and when things are going well, especially, it's easy to say, you know what, maybe I don't need that protection. So when we bring people down to ground and say, wait a second, if I said to you tomorrow, you just give me your money, and I'm going to give you back that 16.42, and it was a money market, would you do it? Everybody's going to answer yes, right?
Absolutely. Well,
So,
let me just say one more thing because I always want to give investors, traders, both perspectives.
sure.
These are low risk strategies.
Right.
They are not no risk strategies.
That's for
So
sure.
what we're doing when we're using these strategies with the BCI methodology is we're throwing the odds dramatically in our favor, but we are not guaranteeing success with every single trade.
Yeah, you
And we
can't.
haven't even, you can't, because if by definition, Howard, and you know this better than most, if you're seeking to generate higher than risk-free returns, by definition, you're willing to incur a certain amount of risk. And if somebody's promising you the moon, hitting grand slam home runs all day long, tens of thousands of dollars flowing into your
Yeah.
account, endlessly, that means you're incurring a huge amount of risk. So you have to
Right.
understand where am I, and we talked about the risk reward spectrum in one of our
Sure.
previous discussions. So again, you can lose money on these trades, but if you do everything the way we have things set up, the rules and guidelines in the BCI methodology, the odds are thrown dramatically in your favor, and you're going to end up putting yourself in a position to have way more winners than losers. and then you could use the exit strategy arsenal to mitigate the losses and enhance the gains.
Absolutely. It's all about asymmetrical risk, right? That's what we're looking for. Bill Ackerman talks about it all the time, one of the greatest investors out there, in my opinion. And it's asymmetrical risk is what you've provided. You're saying to yourself, if I gave you a return of 16.42 in a low risk environment, would you accept it? Yes. Here is a system that does that. In this case, it's obviously every stock and every option chain is going to have a different return. But, that's what we're trying to teach people. And it's not about hitting grand slams all the time. Again, if you want to take 1 or 2% of your investment money and put it into some of these home runs, as you know, I'm a big fan of it in the crypto side and stuff. But this is talking about having a plan for, not just maintaining your wealth, but growing it at the same time.
Yeah, I mean, I've been doing this for 30 years now, and I haven't stopped.
Yeah, no,
So
absolutely. And
if it
and that's
wasn't
the key,
working,
right? We always say, and it's a testament to what you've put in place and the fact about having the proper risk reward, because people are knocking down your door a little bit to try to get in to get the information, and at the same time, it's put to people in a way that it's approachable. So you've done a great job with getting this out there in a way that I think people can understand for sure. So let's talk about a
okay,
little bit
so
when we talk about NVIDIA. What were the pros and cons to the actual system we just put in place?
well, with the protective put, we are protecting ourselves against catastrophic share price decline. I mean, like you alluded to before, some of these high flying tech companies, it is possible that they could take a downturn and still in the long run be way up, but in the short run
Yeah,
go down. So protect us against that. Um, when you set up these collars, it should always be set up with a net option credit. We're here to make money,
right.
not lose money. So it's a net option credit with an insurance policy. The upside potential is the same as the original covered call trade, but again, having this in place may help us sleep better at night. Only you know what the right strategy is for you. Now, let me just throw in one more thing, if I may, Howard, here. I just want to point out that I don't remember if it was our last discussion or the one before that. We talked about using in the money call strikes as a free form of insurance, and I mentioned it earlier. So your viewers should have a look at in the money calls versus protective puts, because if you're doing an in the money call, we're not paying for that insurance.
Right.
It's not as it's not as hard and fast as the protective put, but it will give you a much lower break-even price point. So your viewers should maybe pull up that discussion we had previously
Absolutely.
on bear and bull
I
ways of
have one
placing our
question
trades.
for you on that. Is there one do you is would you say that the in the money call is I'm trying to use the word correctly, is one for more of a catastrophic move than one as a more immediate where you're still making, you know what I mean? Is you're more protecting but keeping not losing as much profit, but you're leaving more room to the downside still if you use the in the money?
I use the in the money. I'll tell you the truth. I don't really use the collar that much. I
Okay.
know a lot of my members do, because the main reason I'll use the collar if I'm traveling. Like I do a lot
Okay.
of live presentations,
Yeah.
and I'm not able to get in front of my computer, so I'll put a few collars in those situations. But if you call, and I'm sure I must have talked to you about this, I always avoid earnings reports.
That's right.
100% of the time, I avoid earnings reports. And that's the main reason for dramatic share price decline. Now,
Sure.
look, bad news can come out unexpectedly at any time outside of an earnings report. So, what I do when I'm concerned about the overall market or if there's an event coming up, I'm going to use in the money call strikes as opposed to the collar. But when I'm traveling and I know that I can't monitor my trades as much as I'd like to, then I'll put on a collar trade. I hope that
Okay.
answers your question.
And I guess is one versus the other more likely to result in the execution of the shares being pulled away, I guess would be the question that I would ask.
Yes, the in the money call strike will be more likely to get called away.
Okay, so
Because
maybe
remember,
and that's where I think somewhat what I was leading you to something because I had a comment that I've noticed with you is what you do a lot. It seems like in your own personal trading is you value the money, the time money component very much, and that's a big part of play. Is where my money is being used, is it being utilized right? And that's what I was sort of getting to. You have no problem sometimes. It seems like with your shares, you're very unemotional in a good way and that if the shares get taken away you're like maybe I'll get back in it or I'll find another trade to get it into, whereas I think some beginning traders sometimes get more emotional about a stock. I don't want to miss Nvidia's next move, so that's what I was sort of leading to, that I think it's that person that's saying I'm willing to take a little bit of a haircut but I don't want to be out of these shares.
okay, well, there's two completely different things in what you're discussing now. One is, and you said that I care more about the premium than about the stock, and you're 100% right about that. I could care less about the stock. I just leverage stocks. I just leverage stocks to bring cash flow into my account.
Right.
Period. And if that stock, if there's early exercise and my shares are taken away before expiration, which is extremely rare, I could care less. As a matter of fact, it's almost reason for celebration
Yeah.
because now I have the cash back. I've maximized my trade, and I could start another covered call in the same contract cycle, an additional income stream. Now, the other thing that you brought out, which is an important point, and I'm glad you did, is that what if you're dealing with a stock that you really want to hold on to for the longer term and you don't want those shares taken away? Well, in that case, there's a very specific way of writing covered calls. I call it portfolio overwriting, where you're going to use a much deeper out of the money covered call, much higher than current market value,
Okay.
which has a very low delta, very low probability of ending up with intrinsic value, and you must learn then how to roll an option if it is in fact expiring in the money. So those, in general, have my shares, have a nice life,
Right.
enjoy.
Yeah.
But if the stock that I really want to keep, I'll craft my trades differently.
Okay, that's why I wanted to ask because I've noticed that it makes all the sense to me, and I've learned to not be emotional about stocks that way because of the fact is, like you said, is it's an instrument for you to write the calls against. It's all it is. It's just the way to do it. It's like having property and renting it out. Is how I would sort of put it for those that don't quite get what we're saying.
Yeah, I mean, we don't care about the stock. We care about the money.
Yeah.
It's the cash, that stock that we care about. And whether it's stock A, B, C, or D, it doesn't matter as long as it keeps bringing in money. I send my stocks out and I tell them to come home with friends.
I love that technology. I love that. I love it.
So just to summarize, Howard, and thanks again for this discussion. I love talking about these things. The collar adds a protective put. So you have your covered call trade, and then you buy a protective put, and it'll protect us against the dramatic share price decline. The time value returns will definitely be lower than a traditional covered call, but you're buying an insurance policy, and that's why the returns will be lower. And this particular trade can absolutely be managed by our BCI
Yeah.
trade management calculator. You do that by deducting the put premium from the call premium, which should be a net credit, and that's what you put in to the premium cell when you're doing your calculations. And that spreadsheet will allow you to have both initial and final calculations.
Yeah, like I said, I thought this was great because I had never thought about using a caller in this way. And you gave some great information as we went along that, I think new investors will learn a lot from these type of systems and by understanding all that goes into trades because it isn't for you when I ask you a question you just go boom 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 and you rattle it off. They don't realize 30 some odd years it took to get that way, but what you've done is you've put that pen to paper so to speak, and these calculators you were nice enough to send me one of them. I've been playing around with it, and it really does. It takes a lot of this guesswork out. It means I don't have to figure out how to make an algorithm, but with some common sense, and that's what sort of to me a lot of the things that you do just take common sense in, like you said, and the ability to reduce risk while still earning profits. And like I said, to me, I look at your system as almost like selling, you're renting out real estate. The only real estate, though, is your stocks.
Yeah, it's a great example. It's a great analogy. I use it a lot myself.
Then the good part, you don't have to worry about those deadbeat, tenants.
I did have a real estate business for about 10 years. And yeah, tenants not paying their rent and all that kind of stuff. So it's much easier to sit down in front of your computer and just generate income this way.
I love it. I love it. Well, thank you so much again, Dr. Ellman, for sharing your knowledge with us on a weekly basis here. Those of you that have been joining us for the first time, there is a playlist on our YouTube station that has all of Dr. Ellman's interviews with us. This is our seventh one. I highly recommend you go through all of them. It brings you through all of the things that we talked about today. That he went back and talked about not using the strategy during earning reports. We did a whole episode on that, a whole interview. We've done an interview just on diversification of portfolios and how that works into the strategy. So it's really been a great learning for me. I take these things and I'm learning every day, so I really appreciate it. Thank you so much, Dr. Ellman. Have a fantastic week.
Same to you, Howard. Be well.